A few years back, I was invited to a trading event. One of those large format affairs. A big auditorium, thousands of people, large production crews with drones flying. There was one speaker in the program who was going to talk about how he uses moon cycles to predict stock markets. And here's the thing, the room was packed to the brim for this person. People had come from far off cities and towns specifically to listen to him. It almost gave me a feeling of an evangelist seminar. The presentation itself was fairly predictable. You pick some dates, you pull up the Nifty chart, you find the places where the full moon or the new moon lines up with the market top or bottom, you build a narrative around it. The chart obviously looks compelling. The audience is convinced with very audible gasps. You will find the same on YouTube. Channels with names like Astro Markets or titles like Use the Moon to Time Your Trades, videos with millions of views. This is not some fringe activity. There is a massive audience for it. And here's the thing we don't realize. Using celestial events to understand or predict what happens on Earth is perhaps one of the oldest intellectual traditions in human history. The Babylonians, for instance, were systematically recording lunar omens and their relationship to earthly events as far back as 1650 BC. The Vedic nakshatra system, which maps the moon's transit through 27 lunar mansions, was already a highly developed framework by around 1000 BC. And you see, as a culture, we deeply value these ideas. And this thinking has evolved over thousands of years. And that's probably one reason why people still find it hard to simply dismiss it. The West has not been far behind. As recently as 1991, J. Wells Wilder, the man who gave us the RSI indicator, published a book called The Delta Phenomenon, which argued that all freely traded markets repeat in predictable patterns driven by the interaction of the sun, the moon, and the earth. He was indeed a serious practitioner of the markets, and he made such a claim. And then there are the academic papers, published in peer-reviewed financial journals, tested across decades of data and dozens of countries and markets. Some of them find some effect. I mean some sort of a correlation. Whether that effect on the markets is genuinely lunar or whether it can be explained by something far more simpler is exactly what makes this interesting. This episode is all about that. How and where did this idea of predicting the markets from lunar cycles come from? What exactly is it? Is there a real effect to it? And should you be making your investing and trading decisions based on it? Well, I'm your host Sandeep Rao, and let's start with looking at the sky. Some disclaimers before I get started with the next section. The examples and ideas shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in stocks or derivatives involves significant risk and can result in complete loss of capital. The examples and data presented here are meant to explain market behavior, not to suggest that similar outcomes will occur in future. And before we go further, here's something personal. You see, astrology and data are two parallel lines. In the context of markets, they operate on completely different foundations. One on belief and the other on evidence. And over years, I have come to accept that no amount of data will move someone who is a true believer. Just as no amount of conviction will move someone who only trusts raw numbers. These two lines do not intersect, and trying to force them to is a futile exercise. So you may ask, why do this episode at all? This episode is not for the true believers, and it's not for the hardcore skeptics either. It is for those who are sitting on the wall. People who have wondered whether there is something to this, who have seen the YouTube videos, who perhaps consult an astrologer or a panchang but are not sure how much weight to give it when making financial decisions. If that is you, then what follows is an honest attempt to look at the question with data and give you a more grounded and rational way to think about it. That is the only purpose of this exercise. Like I always do, let me first explain what this lunar cycle is all about. You see, the moon completes one full cycle from new moon to new moon in approximately 29.5 days. Astronomers call this the synodic month. In Hindu astrology, it is known as the Chandramasa. Within that cycle, there are 4 distinct phases. The first is the new moon, when the moon is invisible from Earth. what we call Amavasya. The first quarter, when you see the right half lit up, is the next phase. And then we have the full moon when the moon is completely illuminated, what we call Purnima. And then we have the fourth phase or the last quarter when the left half is lit. And then the moon disappears again and the cycle repeats. Now here's some historical trivia for you to think about. Ancient Hindus built an entire way of life around lunar calendar. The nakshatra system divided the moon's monthly path through the sky into 27 specific star regions, each with its own name, character and significance. The fortnight from Amavasya to Purnima, the waxing phase, is called Shukla Paksha. The fortnight from Purnima back to Amavasya, the waning phase, is called Krishna Paksha. These phases were the organizing frameworks for rituals, agriculture, medicine and daily decisions. The Panchang, which millions of Hindus still consult today, is built on exactly this foundation. And the precision with which this was done is remarkable. Aryabhatta, working in 499 CE, so 15 centuries ago, without a telescope, calculated the length of the synodic month to within 0.001% of the value modern science arrives at with atomic clocks. It's mind-blowing how the ancient Hindu astronomers understood celestial movements with extraordinary precision. And they had woven it into the fabric of everyday life in a way that no other civilization quite matched. Incidentally, several centuries earlier, astronomers in ancient Babylon, which is around modern-day Iraq, also came up with similar calculation, but the use of it did not continue. Now, how do traders and astrologers connect this cycle to markets? So the basic idea is this. The waxing phase, that is the Shukla Paksha, is associated with rising energy, optimism and growth. The waning phase, which is Krishna Paksha, is associated with decline, retreat and consolidation. The trading strategy that follows from this is simple and straightforward. Buy around Amavasya, sell around Purnima. In other words, buy on no moon day and sell on full moon day. Hold for roughly 14 days, repeat every month. Some people go further. They look at specific phase days as turning points. The full moon as a market top and the new moon as a bottom or vice versa. They plot these dates on a stock or an index's chart and look for alignment. And because markets move every day and lunar events happen every 2 weeks, you will always find some alignment if you look hard enough. And that is precisely the problem. And I will come back to it. But yes, in general, the core hypothesis is this. The moon affects the human mood and behavior. Mood affects investor sentiment. Sentiment moves markets. And therefore, the moon moves the markets. And this is the line of reasoning. And let's see how much of it holds up. So far, we have some sense of what this lunar cycle is, how old the idea is, and how it has been used in markets. Before I get into the specific of testing and hypothesis, let me mention a few names you may have come across. People who used parts of this idea but never relied on moon cycle by itself alone. These are also people who have single-handedly made moon cycles and related ideas quite popular among traders. The first name is W.D. Gann. Gann was an American trader and author born in 1878 and probably the most legendary and the most mysterious figure in the history of technical analysis. His core idea was that markets move in predictable cycles governed by time, price and geometry, and also that celestial cycles, including the moon, were the underlying engine. One of his most studied tools is the Gann angle, a line drawn on a price chart at a specific geometric angle, the most important one being the 45-degree angle, which he called the 1 cross 1. When price moves in harmony with time along this angle, the trend is considered balanced. When the price breaks below it, the trend weakens. Now, does it hold up? Well, the traders who swear by it can always find examples where it worked. But rigorous testing does not confirm it as a reliable edge. He deliberately kept the lunar component hidden, coded into his books, swearing associates to secrecy. And here is perhaps the most telling detail of all. Alexander Elder, who wrote the book Trading for a Living, interviewed Gann's son, who worked as an analyst at a Boston bank. The son told him that his famous father could not support his family through trading and apparently earned his living through writing and selling instructional courses. When Gann died in 1950s, his entire estate, including his house, was valued at just over $100,000. The second name is J. Wells Wilder, the man who gave us the RSI. In 1991, he published the book The Delta Phenomenon, whose entire hypothesis fits in 18 words. Markets repeat directly or inversely relative to the total interaction of the sun, the moon, and the earth. In the book, Wilder describes receiving a phone call from a man named Jim Sloman in 1983. Then Wilder flew to Chicago to see Jim's system and apparently wrote him a check for what he calls, in his own words, a very large sum of money. Post which Wilder built a system of 5 nested lunar and tidal cycles around it. The catch in all of this is the word inversion. When the prediction is wrong, the system calls it an inversion. You see, a framework that explains both outcomes actually explains nothing. It's a bit like saying, this time the breakout failed, but it works most of the times. And finally, did you know that JP Morgan, the man who single-handedly bailed out the US government during the panic of 1907, seems to have paid an astrologer a retainer every year? Her name was Evangeline Adams, a respected astrologer in America at that time. He kept the entire thing private. The famous quote usually attributed to him, that is, millionaires don't use astrology, billionaires do, is almost certainly fabricated. But yes, the astrologer in this case was real. Make of that what you will. Now let's for a moment put on our quant hats and look at some data. I have intentionally kept the hypothesis and the backtest very simple. Unlike how we dig deep in our long and short episodes, because I first wanted to see whether all the story about moon phases has any substance in the first place. If it does, I'll definitely dig deeper. I have used Nifty 50 Spot as our instrument, as this is just a baseline test. For this strategy, we have 2 dates which act as decision days: New Moon Day and Full Moon Day. So keeping them as references, I have designed 4 strategies. Strategy 1, New Moon to Full Moon. We buy the next trading day's open after a new moon and sell the next trading day's open after the full moon that follows. In between cycles, we have no positions. Strategy 2. Full moon to new moon, the mirror image of strategy 1. We buy after a full moon and sell after the new moon. Same idea and no positions again in between. Strategy 3. New moon to full moon, but an SAR strategy. SAR means stop in reverse. We never have no positions here. We go long after a new moon, and the instant the full moon hits, we flip straight into short, no pause. And then at the next new moon, we flip back to long. Constant back and forth. Strategy 4 is full moon to new moon, stop in reverse. Same stop in reverse logic, just starting at the other leg. Long after a full moon, flip to a short after the new moon, flip back to the long after the full moon that follows. I think these 4 are good baseline strategies to test. Now let's look at the equity curves for each of these strategies. Ignoring the buy and hold, the long only strategy where we go long on Purnima, the full moon day, and exit on Amavasya, the new moon day, outperforms the rest. It generated 6,849 Nifty points over the period against 2,880 points for the reverse strategy, with a return to max drawdown ratio of 4.27. But look at the win rates. Full moon to new moon wins 58.7% of the trades, new moon to full moon wins 56.4%. Both are barely better than a coin toss. And we've not included transaction costs or slippages in any of this. Factor those in across 327 trades and whatever little edge that exists may disappear entirely. And yes, look at how the strategy 1 was initially lagging and then strategy 2 took over. Maybe something changed in the planetary configuration. Okay, I'm just kidding over here. So that brings us to the most important point. Perry Kaufman, who tested similar strategies on US markets, arrived at the same conclusion we are arriving at here. Whatever gains you see in the long-only strategy are not a lunar effect. They're simply a function of markets' general upward bias over time. Buy and hold return of 22,354 points over the same period with a return to max drawdown of 4.7, better than any lunar strategy, fully invested, 0 timing required. You see, any strategy that keeps you long for roughly half the trading days in a year, regardless of which half, will tend to show positive returns in a rising market. You could pick any 2 calendar days, go long between them, and quite possibly you will see a similar result. The moon has nothing to do with it. Before I wrap up, 2 ideas worth holding on to. The first one is probably something you heard before. Correlation is not causation. I have a whole episode on it. The fact that markets tend to do something around a full moon does not mean the moon is causing it. It could just be a coincidence. There could be a third variable nobody has identified. That's possible too. Or it could simply be the market's upward drift showing up in whichever half of the month you happen to measure. Also, finding a pattern in the data does not tell you why the pattern exists. The second idea is less talked about but equally important. If you look hard enough at any dataset, you will find a pattern, some pattern that is. Markets move every day. Lunar events happen every 2 weeks. Given enough history, some alignment is mathematically guaranteed. So the question is never about whether a pattern exists. The question is whether it is an exploitable edge after costs, after slippage, and out of sample. On all three counts, the lunar strategies we tested on Nifty do not clear the bar. Well, there may be a pattern here, and it genuinely is fun to look at, especially if you're selling seminars. But a pattern is not an edge, and an edge on paper is not money in your account. Those are three very different things, and assuming them to be the same is exactly how you sell seminars. And that brings me to the end of this episode on moon phases and its effect on index returns. I hope you found this episode useful and interesting. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.